lesson. In this lesson, we are going to look at a question that was tested in August 2023 in financial management, and we are looking at question number 2. And question number 2A asks like this: distinguish between temporary working capital and permanent working capital in relation to working capital management. So, when you want to distinguish is give their differences, we can have we can do it this way. We can have temporary working capital, and then we have permanent working capital. As the name pronounces, temporary is something for short term, and permanent something for a long term. It is 2 marks, but I'll give you at least 2 differences. So when you're talking about temporary working capital, one, we see that this is the amount of working capital, required to meet short-term fluctuation in business. Short-term fluctuations in business. While when we talk of permanent, we are saying that this is the amount of working capital, that is required to meet the ongoing day-to-day operations of the business. That is the first difference between this. The second one, with the temporary working capital, is required for just a short time, period of time, such as seasonal variations in demand and supply, and temporary increase in inventory. That is temporary working capital. By the way, temporary working capital is affected by the current asset less current liabilities. Now, when you come to permanent, here we are talking about required for a long period of time. For a long period of time, for day-to-day operations of the business. For day-to-day operations of the business. So there are so many differences among these two. Me, I've just picked 2. So you require to read more on the same. Now we go to we go to part 2. It's saying that the monthly working capital requirement for Mbunu Limited are given as follows. We have the months. These months begin from January to November. In fact, it should be January to December. There is December here, 3,800. The short-term cost of financing working capital is 15% per annum, where the long-term financing cost is 20% per annum. The firm adopts an aggressive policy in financing working capital needs. 80% of the firm's permanent working capital are financed using short-term, and the balance is financed using long-term. Look here, 80% of, so we have to distinguish between the short-term and the long-term working capital, so that we now evaluate 80% of the firm's permanent working capital are financed using short-term funds, and the balance is financed using long-term. Required, determine the total cost of financing the working capital needs of the firm. So we have to separate the temporary working capital and permanent working capital. Now, we come here and create a table. Let's create a table here. And we call this table here, this part here, we can call this one months. Then here we shall have total working capital. Total working capital. Then we split this working capital into permanent working capital, and then we shall have, finally, we shall have temporary working capital. In the first month of January, we are going to split, the total working capital is 3 million. Split this one, 1.5 million, 1.5 million. Month of February, the total working capital is 2,500,000. Yeah, 2,500,000. This is given in the question here. We have in 3 million. You see, these figures are in thousand. So when you see 3,000 here, it means 3 million. The figures are in thousand. We split this one, 2,500, 2.5 million. So here we have 1.5 million. So of course the balance is 1 million. We come to February, we come to March. The total working capital has been given here. I want to remind you that this is 2,000. This is 2,000. Split this one into temporary. Not 2 million. 2 million, you split this one. 1.5 million. Of course, the other one is 500,000. We go to the month after March. We go to what? April. We go to April. The figure given there is 1.5 million. Split this one. If you give 1.5 million permanent, means there is no temporary. Go to May. Go to May. The figure given there is 1.5 million as the total. If you give permanent 1.5 million, it means there is no temporary. Go to June. Just a reminder, you see, I'm picking these figures from here. I'm in June, 1.7 million. So I give 1.5 million to June. I give 1.5 million. This is 1.7. 1.5 million to permanent. Temporary is 200. Come to July. July, you have 1,800 as the total. Give 1.5 million to permanent. Temporary is 300. Come to August. The total given there is 2.8 million. 2.8 million. 1.5 million goes to permanent. Temporary is 1.3 million. Go to September. September, we have 3.2 million. You split this one. 1.5 million goes to permanent. The difference is 1,700,000. After September, we go to October. We have 3.5 million. Give permanent 1.5 million. The difference is 2 million. We have November. November, we have 3.6 million. Give permanent 1.5 million. The difference is 2,100,000. And finally, we have December. December, we have 3.8 million. Give permanent 1.5 million. The difference is 2.3 million. Get the totals now. We get the totals. Add everything for here. The total here will be that 1,900,000. Add everything here. This gives you 18 million. Add everything here. This gives you 12,900,000. When you add these two, they should give you the figure given here. So we are looking for the cost of financing. Cost of financing working capital. Financing working capital. How do you calculate this? We've been told that 80% of long-term cost is financed by short-term. So this is, we take 80% of the short-term, 80% of the long-term are financed by the short-term, times 15 over 100, plus then 20% of the long terms. If 80% is financed by the long term, it means the 20% is the one financed by the long term. Multiply by 18, then multiply by 20 over 100. That is it. Now in this case, we shall have, there is additional point here. Additional point here. You see here, you are told this point here. You are told that the short-term cost of financing working capital is 15% per annum, while the long-term is 20%. So we need the short-term cost of financing plus what I've calculated. There is the long-term. 15% is the short-term times 12,900. When you add this, you have 2,160,000, then plus 720,000, then plus 1,935,000. This will be the total cost. That is 4,815,000. That is it about that question. How to get the financing through the working capital management. We go to part B. Part B, you are told that FIFA Limited is considering to purchase a new machine so as to improve its production process, which is currently being undertaken manually. The machine costs 13,950,000. That is the buying price. The firm will incur installation costs 450,000. What do you do in installation costs? You capitalize that. Installation cost is capitalized. When you buy a machine and you incur cost to install that machine to its operation, that cost is capitalized. The machine will have an economic life of 6 years, and but will require an overhaul cost at the end of the 4th year. Overhaul cost here, that means you overlook the whole procedures. Overhaul will cost 1.125 million. After 6 years, the machine could be disposed for shillings. That is scrap value. The scrap value or the income after 6 years. The company estimates that it will cost 2.1 million per year to operate the machine. The current manual production method costs 250 per annum. In addition to reducing annual operating costs, the new machine will allow the company to increase the production capacity by 120,000 units per annum. The company realizes a contribution margin of 45. The additional information: the company applies straight line method of depreciation. The corporate tax rate is 30%, and FIFA Limited requires 20%. The cost of capital, or the expected rate of return, is 20%. Then, using the net present value project evaluation method advise FIFA Limited on whether or not to purchase the machine. In other words, we need to know whether by getting this machine, is the company going to make profit? And you make this profit by discounting the cash flows. Of course, when you're discounting the cash flow, you have to factor in depreciation. But remember, depreciation does not involve the movement of cash. So you cannot discount the depreciation. So we are going to discount all the projected cash flows until we see whether the NPV is positive. If NPV is positive, then we can advise to move ahead. But before then, let's do some calculations here. I'd say that the purchase price, new machine, when you purchase this new machine, is going to be purchased by purchase cost. Purchase cost is 13,950,000. Then we shall have installation cost. Installation cost 450,000. You capitalize this. That means this machine will have the record in the books will be 14,400,000. Now, how do you compute depreciation? Depreciation here, depreciation. The machine costs 14,500,000, but it will have a scrap value of 900,000, and it will be there for 6 years. So the depreciation cost is 2,250,000. Of course, the scrap value is subtracted from the cost, and it's a straight line method. There will be depreciation overhaul costs, depreciation overhaul costs. Overhaul costs here you have been told is 1.125 million. You divide by 2. This gives you 562,500 per annum. Where am I getting this? The figures have been given in the question here. Depreciation overhaul costs you have told here. The overall cost will cost 1.25 million. But this one is happening after 4 years. That means it will only be having 2 years to expire. Machine is supposed to have for 6 years, but it will work for 4 years. So after depreciation overhaul cost, that means machine will last for only 2 years. That's why I'm dividing this one by 2. Then we need to look at operating cash flows. What are the operating cash flows? Operating cash flows. Operating cash flows. We shall have a savings of 52.5 million minus depreciation here. This is 100,000. This gives us 3,150,000. Now let's look at the general. Generally, we look at how the cash flow will behave for the next 5 years, and that not even 5 years, supposed to be 6 years, because the machine will have so here we shall have years. Then we need to look at how the cash flows will behave from year 1. We go to year 2, year 3, year 4, year 5, and finally year 6. So increase in contribution. Increase in contribution. Remember, you have a contribution margin. Contribution margin is 45. You multiply by the total number of units. Here you have 400,000. The same. You see the contribution, the units have been produced throughout. 5. So the contribution will be the same here. 400. The units are the same at this point. 400. 400. Now that is the contribution. Then there are savings. Savings we have calculated here. This 3,150. No, 3,150,000. It will be the same throughout. 3 million. We are saving this for the entire period. 3,150,000. 3,150,000. 3,150,000. 3,150,000. So those are the savings. Now we less depreciation. Depreciation is a cost. The less depreciation. We calculated depreciation and found is 2,250,000. We subtract that one. depreciation is straight line, so it's constant. Subtract that. Depreciation is straight line. We less depreciation. Less depreciation. Less depreciation. Good. So once you less depreciation, there is an overhaul cost that is going to take place after how long? Less overhaul cost. The overhaul cost is taking place on the 4th year. So it means it's only affecting which year? Year 1, there is nothing. Year 2, nothing. Year 3, nothing. Year 4, nothing. Year 5, you divided the overall cost into 2. We have 562,500 and 562,500. The total cost was to be spread out in 2 years. We subtract that. So at this point we shall have before tax cash flows. We shall have what we call before tax cash flows. Remember, I want you to note this: before tax cash flows. You can't tax depreciation. That one is already, you should know that from your tax laws. Depreciation is an allowable expense when we come to taxation. We shall add back depreciation anyway. So we take the difference. This one 6,300. This is 6,300. The reason why these figures is changing year 5 and 6 is because of the overhaul cost, and this gives us 5,737,500. 5,737,500. Now, we less tax at that percent. Less tax at that percent. That percent of this one is 4,100. This is that percent of 6.3 million. Anyway, that's what I'm doing. It is 30%, the corporate, that profit before tax, this one. Then tax. This is you less, this is 410,000. This is 4,410,000. 4,410,000. 4,410,000. Wait a minute. You are supposed to get 30% of 6. This I'm giving is after tax. You are supposed to get 30%. The tax is 30% of. It can be almost the same. 30% of 6.3 million. If you pick your calculator here, this should be 1890. This is 1,890,000. Sorry for that. This is the tax. 1,890,000. The same figure here, 1,890,000. The same figure here, 1,890,000. But here it is going to change because the figures are different. 1721, 250. 1721, 250. We are subtracting this. These are taxes. Now, after tax cash flows, now, when you subtract this, you get after tax cash flows. That's where now we take 6.3 million minus 1.89 million. You get 4,410,000. 4,410,000. 4,410,000. 4,410,000. Then this is 4,116,000. 4,016,250. 4,016,250. This is after tax cash flows. But remember, I said before, add back depreciation because depreciation is non-taxable. Why we normally say that depreciation is non-taxable? It does not involve movement of cash. You say your vehicle has depreciated, yes, but there is no actual cash that has flown or gone out. So here you have depreciation was constant, add it back, depreciation was constant, depreciation was constant, you add it back throughout. The last year depreciation was 28. Do you know why? The asset were, they incurred an overall cost. That's where the depreciation will change. By incurring the overall cost means the asset gain more value. Now, let's the overall cost. The overall cost took place on the 4th year. Overall cost. It took place on the 4th year. First year, second year, third year, there's nothing. 11,250. Then, so after this, now we can now be able to get the cash flows at the cash flows. For the first year, it will be 6,660,000. It will go the same for the next 3 years. It will go the same for the next. The 4th year it will change because of the overhaul costs. The cash flows will reduce, and the 6th year the cash flow will increase because the machine is going to be 77, 28, 750. You are told in the question here, this part, the last statement here, you are told that the FIFA Limited requires rate of return is, we now look at the present values of this, discounted at 20%. You discount these cash flows at 20%. You know how to find the discount rate? It is the first year it will be 1 over 1.2. This will give you 0.833. Second year is 1 over 1.2 squared, 0.6944. Or you can use the financial table, which will be provided in your exam, 0.5787. I've taught you how to use financial table before. And then this is 0.4823, 0.4019, and finally 0.334 now. Now let's look at the present values now. Present values. You take 6.6 million times this discount rate. So here you have present values, PVs. You shall have 5,549,778. Here we shall have 4,624,704. I'm taking this multiplied by this. This cash flows times the discount. The present value interest factor. This one is called present value interest factors. This one will give you 3,854,142. This gives you 2,669,531. This gives you 2,744,475, and this one gives you 2,588,3,584. So these are the PVs. These are the PVs. When you add all of them, they will give you what? Let's put the total here. Add this. Let me have this, my calculator here. We see what is the total here. When you add all of them, you get 2 million. In fact, not 22 million. You get 22,230,988. You subtract how much this machine, when you buy this machine, when we added the installation cost, it was 14,400,000. That is the money that was to be spent to acquire this new machine. So when you do the difference, you have 6,630,988. By acquiring these machines means that the NPVs are positive. NPVs are positive because you're getting the PVs of, this is NPVs. NPVs happens where you have the PVs minus the initial outlay. NPVs. So advise, since the NPV is positive, you can advise the management to buy a new machine. So you can say FIFA Limited should purchase the new machine. Since it has a positive net present value. We are getting NPVs are 7,630,000. So this is what you expected. You see, when you evaluate the importance of having or buying a new machine, look at how much cash flows that this machine is going to bring. Then you discount this machine based on expected rate of return. And if the cost of acquiring machine is greater than the present value, then it means you don't need to buy that machine. But if the cost is less than the present value, it means there will be cash inflows, so you purchase the machine. Otherwise, that's how you're supposed to do that question and score your 20 marks. We're going to stop there. We'll meet in our next video.